Hey guys, what's good? I'm Andre and today I want to discuss the idea of selling puts on GGPI with you guys. Before we jump in, I'm gonna plant one tree for every 20 likes this video gets, guys. Help me out and we're gonna help the planet out as well. This is actually a question that I received from one of you guys, and again I encourage you to ask those questions. I'm more than happy to answer them outright or to make a video on some of the more intricate topics, just so more of you guys can really understand the thought process behind what we do. So guys, why would we actually do that? And as you can see, our good friend here on the channel asked whether or not he should buy a call. And again, the recommendation is here mostly to sell. Be a net seller of options. That's the best way of making sure that you generate sustainable long-term growth instead of buying calls. Buying calls is way harder to do, guys, and way harder to do successfully and to do successfully over a long period of time. So I don't really have a very good understanding of what he wants to do here. Buy a call when, at what strike price, what's the expiration, what's the delta. So let's look at some scenarios here and let's look at why I think it's a great idea to sell a put right now. Cool guys, so here we have GGPI and we're gonna look at a few scenarios. So first off, let's just assume the fact that he meant buying a call in January. So if we go ahead and buy a call in January, let's pretend that we're gonna buy the $12.50 strike price. And as you guys can see right next to my mug here, we have the bid-ask spread, which is between 40 and 35 cents. So the ask right now is 40, the bid is 35. Now it's before market opens, so the data is bound to be a bit skewed. That being said, let's analyze the data that we do have in front of ourselves. So buying that January 21st call for, let's say, $40 to keep the math really easy for us. What does that actually mean? Let's pretend that we fast forward to January 21st, the stock rallied to $12.6. Have we actually made any money? And the answer there is absolutely not. The stock needs to rally not to the strike price, which is 12.5. It needs to rally to 12.5 plus the 0.40 here that we paid for the premium. So it needs to rally as high as $12.9 per share in order for us to break even. Our profits start later, guys, and that's the one thing that many of us don't really understand about buying calls. Now, the second really important aspect, and this is something that you actually don't see on the screen here, but I can tell you, there's a 1 cent theta on this strike price. So guys, what the 1 cent theta means is that from the 40 cents that we paid for it, and again I want to remind you that options contracts have 100 shares in them, so we'd basically pay $40 for this call, and then the theta would eat away $1 per day. It doesn't matter if it's Christmas Day, it doesn't matter if it's weekends, it doesn't matter. Theta doesn't care, it eats away at that premium, which is why I would rather be on the net seller end of things rather than the net buyer end of things. With that in mind, again, we have bought this call. If it doesn't rally pretty fast, guys, we're gonna end up being pretty much negative throughout. Let's pretend that indeed it does rally above $13. You end up not making a fortune there. So that's why I really recommend that you guys get into the mind frame and jump on the train of net sellers for options. Now let's look at what selling a put means. Basically, let's pretend that, again, Polestar, a phenomenal company, guys. I encourage you to have a look at this video that I'm gonna link here and down below in the description. We did a lot of technical analysis on Polestar and we've identified the fact that it's truly a phenomenal company. I expect the moment that it does list with PSNY on the stock market, basically the merger would be complete somewhere in the first half of 2022. We're already pretty near that. I expect the stock to be roughly at $25, and then from there I expect it to end the year roughly between $30 and $35. Obviously we cannot predict the future, but there's a lot of intrinsic value there. Check out that video. Again, I speak about it at length and highlight why some of them are such in a deep value territory. So with that in mind, guys, I really want to buy this stock, right? How do I go about it? Do I just outright buy it at 11:21 now on the 22nd of December before market open? No, I'm not gonna do that. I want to be able to have a really sweet entry price. So I have a couple of options here. Let's pretend that, again, we go out to the 21st of January 2022 and have a look at the puts here. So actually, by selling a $10 strike price, we don't really achieve much. This is both because of lower implied volatility probability for this one specifically, but it's also because it's a SPAC and the SPACs have a $10 floor, so the risk implied at $10 strike price is basically zero. That's why you won't be able to achieve much. But what happens if we sell a put at $12.50 strike price? And you might wonder, why would you ever do that when the current price is lower than $12.50? And actually I think that this is a pretty sweet opportunity for you guys to learn something, because we're gonna sell an in the money put, which is something pretty unusual. So here the blue background means that the strike prices are in the money. This is unusual. We usually sell out of the money puts. So with that in mind, guys, why would we do that? Again, we're at 11.21 per share. Why wouldn't we just buy 100 shares outright? That would of course lead us at an investment of $1,121. So roughly a great investment for a smaller portfolio, right? Well, guys, if we sell the $12.50 strike price for January 21, what we actually would be able to buy the 100 shares for is not 12.5, and let me explain. You're basically gonna be selling the 12.5 strike price, and then you're gonna make a premium of whatever you manage to get assigned for between the bid ask price here. So the bid is 155, the ask is 170, and again a reminder that we're dealing in hundreds of iterations. So we're buying 100 shares and we're gonna get paid not $1.55 or $1.70, but $155 or $170. And for really easy math, let's just keep it at 160. So let's pretend that we got assigned this put at $160. We immediately have that money in our portfolio. It's available for trading. How does that impact our move here? We sold a $12.50 strike price, right? So if you guys do a bit of math, it's pretty easy. But if we deduct 1.6 from 12.5, we're left with 10.9. So for $10.90, you're gonna be able to buy 100 shares, which obviously it's below the 11.21 that we currently have listed by roughly 30 cents. So that's why, guys, it's so important for us to sell puts instead of buying calls, or instead of outright buying shares. Selling puts always gives you a better opportunity to enter that same stock at a cut price. Now, guys, what happens if we do get assigned that put? Again, we're buying 100 shares of GGPI at 10.9 per share. That's fantastic. We have a fantastic entry price and we can see where GGPI is by that time. Let's just play pretend here. GGPI would be at $12.4. You get assigned because it's in the money, it's under 12.5. So from 12.4 you have it at 10.9, so there's another $1.50 for you to be made there by selling them immediately on the spot. You don't even have to wait further. Now, what happens if we don't get assigned? So basically, let's pretend that the stock is at $12.51. It doesn't have to be higher than that, so literally 1 cent above the strike price there, and you're in the clear. You don't have to buy the 100 shares because this is an obligation only if it's in the money. So you won't have to buy the 100 shares, but you will still keep the $160 that you made by selling this option, guys. That's exactly what I mean about selling puts, and that's exactly why I encourage people to do that, especially when markets are a bit volatile and they can offer us quite hefty premiums. Not only do you get a really great entry price for a stock that you want, do not sell puts on shit stocks, only do it on stocks that you truly love, but you also have the chance to basically make a premium every single month by selling puts on different stocks, and then have that premium remain in your account regardless of whether or not you do get assigned. And guys, for some reference, I mean, I do a lot of selling puts, of course, but just to give you a reference of the sort of premiums I've been wielding for the last few months here, I frequently make between 5 and 12% of my portfolio by just selling options for premium. Now, a good part of that, of course, is selling bull put spreads or bear call spreads, so selling more advanced option strategies, but selling puts is an important part of that as well, and it's actually one of the best that I use as well. So definitely nothing against that. Guys, I do want to remind you that I'm gonna be starting a new portfolio here that's gonna have a value between $3,000 and $5,000, and we're gonna start showcasing it on the 1st of January, just so we have a full year ahead of us to attempt to beat the markets, and through the strategies that we have, selling options, investing long term, and then some short term swing trading, we hope to be making quite a good buck, and again beating the markets by a couple of times, if not more. I encourage you to subscribe to the channel and join me on that journey. And guys, I'm gonna start a Patreon here on the page. It's gonna be an easy $5 for the entry level, for you guys to be able to track my portfolio in full, get immediate announcements whenever I make a trade, so that you can follow along and hopefully grow your portfolios alongside mine. Thanks so much for your time, guys. It's been a pleasure as always, and I'm gonna catch you next time. Take care.